Any ETF that's based on spot that gets approved, my guess is you see 10% upside immediately.
Okay.
Like within minutes, you'll see Bitcoin up because everyone's going to rush into it and shorts are honestly going to freak out and cover. The question is it a long-term catalyst? And I think longer term it is because it does kind of give the additional validity to Bitcoin as an investment for a lot of Main Street. And still, we're still looking at older generations, baby boomers, who really aren't invested at all in Bitcoin overall. So I think there's a lot of money there. We know that's a huge amount of income or savings that could potentially come in. And so I think longer term, any sort of approval is a nod from the SEC that this is a valid investment. And we've heard BlackRock's CEO say that at this point. I mean, he's full all in on Bitcoin at least.
Today, we've got some exciting insights to share about the potential approval of a Bitcoin ETF and its impact on the market. But that's not all. We'll also dive into the current state of the U.S. economy and its implications for both traditional markets and cryptocurrencies. So, if you're eager to stay ahead of the curve in the world of finance, smash that like button, hit subscribe, and let's get started.
The lack of volatility in Bitcoin has actually been astounding. I mean, when was the last time you and I sat here and said the stock market's way more volatile than cryptocurrency? And that's where we are at this point. So I do think that that's the case at this point, is that everyone is now waiting on this. And also I think we have to look at what happens. And this is my kind of negative for Bitcoin specifically, is that I think the regulatory stuff is behind Bitcoin. It's going to be slowly more and more accepted by the big players out there, the institutions, and really people in general. But my only concern for Bitcoin is if the stock market were to hit a major bump. And if we saw, let's say a drawdown on the NASDAQ back to October lows, if we look at the NASDAQ, in fact, I'm going to show my screen here because I think this is a really important point. I'm going to split up my screen and let's look at this, right? So here we have Bitcoin on one side and the NASDAQ on the other. If we go to the daily charts here, daily charts across the board, what we see if we zoom out on Bitcoin is that we only have retraced at this point a minor amount, right? So if we just do a Fibonacci retrace on Bitcoin to the lows, we've retraced about 25% of the down move. If we go to the NASDAQ, on the other hand, what's remarkable here is we've retraced over 80% from, at least at the highs. We've come back down just a little bit. But my concern is that if this is the best you get on Bitcoin with a huge rally in the NASDAQ, if the NASDAQ just trades back here, where does Bitcoin go? Does it end up going back to these lows of 15.7 or potentially lower? That honestly is my only negative case for Bitcoin. Aside from that, I honestly think Bitcoin is golden. I think it longer term, if your horizon is more than a year or two, I think it's a great investment.
What are the catalysts that would cause the stock market to retrace to where it would have an influence on Bitcoin? Is there anything specific you're watching for?
Yeah, I mean, I think lately we've seen some little signs of that. For instance, Fitch's downgrade of U.S. credit, Moody's downgrading a bunch of banks and threatening the big banks with a downgrade. So I think a credit event would be one of those major potential scenarios that could freak things out. Weirdly enough, that actually could be a positive for Bitcoin. The negative for the stock market that I think would be negative for cryptocurrency and specifically Bitcoin would be more if we hit a recession with inflation still elevated. And if the stock market valuations come in significantly because of a recession and it's not a credit event at that point, I do think money would also kind of be pulled away from Bitcoin just because of the fear factor, the deleveraging going on in the system. So that's really the negative case for Bitcoin. Aside from that, again, it remains very rosy. There's two separate economies. There's no doubt about it. You have people that are struggling because of inflation, and then you have other people that are invested, and therefore they're doing fine because even though inflation's gone up, their portfolios have gone up 30, 40% in this rally from last October. The other thing to kind of keep in mind too, and this is the one that bothers me the most, is, you're now at a point where the U.S. is now paying about $1 trillion of interest every single year. You have credit card debt at $1 trillion. You have the average car payment is something like $700 and change. So there are these things that are just sucking the lifeblood out of the economy. And for me, interest payments are the worst because you're not really getting anything from it, right? It's just, you're basically giving money away consistently. Where that money, I mean, $1 trillion, if it was put instead of towards interest, but put into the economy, would be massively stimulative to the overall economy. I mean, you could literally support tons of people with that type of money. I think initially the markets were relieved, right? It was ever so slightly better than expected, yet still higher than last month, right? We did see an uptick from last month's 3%. So for me, I thought that the initial rally was what maybe could have been short covering, maybe some short covering running there, some people just jumping in saying, okay, it's better than expected. But what's interesting here is that we've actually seen the stock market roll over. In fact, if I share my screen here, you guys can check this out. So this was the initial open on the S&P 500, and we had this really big surge up. But look at what's happened since. We're essentially back to the unchanged mark. So the question here is are people saying, wait a minute, yeah, we were slightly better than expected, but at the same time, we're still a little bit more elevated, which, by the way, anything above 3% is going to make it very hard for the Fed to justify cutting rates at the slightest hiccup in the economy. He has choreographed that, right? He has told us higher for longer. It's been the market that has kind of said, nope, we don't believe him. Let's keep rallying on risk assets. But I think we're starting to kind of recognize that. We see some of the Magnificent Seven tech stocks starting to crumble. Apple, Microsoft down. Even NVIDIA over the last couple of days has taken a pretty big hit as that valuation is just so ridiculous. So I think for Jerome Powell, he's going to likely continue to stay hawkish because he doesn't probably want the stock market as high as it is. But I think, honestly, I'm in the camp that the Fed is done hiking. And I'm in the camp for that reason, because even though jobs have remained good, the underlying is not great, meaning that if you look at part-time work, there's been a big explosion in jobs in part-time, but full-time is actually starting to weaken. And in the latest jobs report, what we actually saw was government jobs. That was a big gainer, but a lot of the private sector saw some reduction. So the underlying numbers in the jobs report are starting to weaken. And by the way, last thing I'll say too is consumer confidence has been another factor that the bulls have kind of hung their hat on, saying, oh, it's so good, consumer confidence. But if you break down consumer confidence to income, the higher incomes, it's been soaring, which makes sense because the stock market's soaring. The lower income is actually plummeting the consumer confidence. And that's, again, these underlying numbers that really mainstream media doesn't delve into, but people should understand. I think the big thing is going to be the jobs reports going forward. So if you see a significant weakening in jobs reports, it's going to basically, guarantee that the Fed is not going to continue to hike. And one of the things that Jerome Powell said in the last press conference was that he was very much under the understanding that the delay in hikes is significant, meaning 6 to 12 months from when they hike rates till it actually hits the economy. So to me, that was a signal that the Fed is likely on the sidelines here. Now, it doesn't mean the Fed's going to cut. I think the Fed cutting is well into next year, but I do think that at least the Fed is signaling that they're understanding that the underlying data is weakening, and they're going to sit back and let these rate hikes take effect before they reevaluate.
Another data Soloway is watching out for is the Producer Price Index, which came in hotter than expected, according to recent reports from the Bureau of Labor Statistics. According to the report, the index, which tracks the average change in prices that businesses pay to suppliers, rose 0.8% annually, hotter than the expected 0.7% increase.
A deep dive into the world of Bitcoin ETFs, market dynamics, and the complex relationship between traditional and crypto assets. As the regulatory landscape evolves and market forces continue to shift, one thing remains clear: the world of finance is in a state of constant flux. So, if you found this analysis insightful, be sure to hit that like button, subscribe to our channel, and turn on post notifications to stay up to date with the latest financial insights. And, as always, share your thoughts and observations in the comments section below.